Brooksley Born asked me if I would come work with her, we decided that this was a serious, potentially destabilizing market.
In May of 1998, the CFTC issued a proposal to regulate derivatives. Clinton's Treasury Department had an immediate response.
I happened to go into Brooksley's office, and she was just putting down the receiver on her telephone, and the blood had drained from her face. And she looked at me and said, "That was Larry Summers. He had 13 bankers in his office." She conveyed it in a very bullying fashion, sort of directing her to stop.
The banks were now heavily reliant for earnings on these types of activities. And that led to a titanic battle to prevent this set of instruments from being regulated.
Shortly after the phone call from Summers, Greenspan, Rubin, and SEC Chairman Arthur Levitt issued a joint statement condemning Bourne and recommending legislation to keep derivatives unregulated.
Regulation of derivatives transactions that are privately negotiated by professionals is unnecessary.
She was overruled, unfortunately, first by the Clinton administration and then by the Congress. In 2000, Senator Phil Gramm took a major role in getting a bill passed that pretty much exempted derivatives from regulation.
They are unifying markets, they're reducing regulatory burden. I believe that we need to do it.
It is our very great hope that it will be possible to move this year on legislation that in a suitable way goes to create legal certainty for OTC derivatives.
I wish to associate myself with all of the remarks of Secretary Summers.
In December of 2000, Congress passed the Commodity Futures Modernization Act. Written with the help of financial industry lobbyists, it banned the regulation of derivatives.
Once that was done, it was off to the races. And the use of derivatives and financial innovation exploded dramatically after 2000.
So help me God. So help me God.
By the time George W. Bush took office in 2001, the U.S. financial sector was vastly more profitable, concentrated, and powerful than ever before. Dominating this industry were 5 investment banks, 2 financial conglomerates, 3 securities insurance companies, and 3 rating agencies. And linking them all together was the securitization food chain, a new system which connected trillions of dollars in mortgages and other loans with investors all over the world.
30 years ago, if you went to get a loan for a home, the person lending you the money expected you to pay him or her back. You got a loan from a lender who wanted you to pay him back. We've since developed securitization, whereby the people who make the loan are no longer at risk if there's a failure to repay.
In the old system, when a homeowner paid their mortgage every month, the money went to their local lender. And since mortgages took decades to repay, lenders were careful. In the new system, lenders sold the mortgages to investment banks. The investment banks combined thousands of mortgages and other loans, including car loans, student loans, and credit card debt, to create complex derivatives called collateralized debt obligations, or CDOs. The investment banks then sold the CDOs to investors. Now, when homeowners paid their mortgages, the money went to investors all over the world. The investment banks paid rating agencies to evaluate the CDOs, and many of them were given a AAA rating, which is the highest possible investment grade. This made CDOs popular with retirement funds, which could only purchase highly rated securities. This system was a ticking time bomb. Lenders didn't care anymore about whether a borrower could repay, so they started making riskier loans. The investment banks didn't care either. The more CDOs they sold, the higher their profits. And the rating agencies, which were paid by the investment banks, had no liability if their ratings of CDOs proved wrong.
you weren't going to be on the hook, and there weren't regulatory constraints. So it was a green light to just pump out more and more and more loans.
Between 2000 and 2003, the number of mortgage loans made each year nearly quadrupled.
Everybody in this securitization food chain from the very beginning until the end, they didn't care about the quality of the mortgage. They were caring about maximizing the volume and getting a fee out of it.
In the early 2000s, there was a huge increase in the riskiest loans, called subprime. But when thousands of subprime loans were combined to create CDOs, many of them still received AAA ratings.
Now, it would have been possible to create derivative products that don't have these risks, that carry the equivalent of deductibles, where there are limits on the risks that can be taken on and so forth. They didn't do that, did they?
They didn't do that, and in retrospect, they should have done.
So did these guys know that they were doing something dangerous?
I think they did.
All the incentives that the financial institutions offered to their mortgage brokers were based on selling the most profitable products, which were predatory loans.
If the banker makes more money if they put you in a subprime loan, that's where they're gonna put you.
Suddenly, hundreds of billions of dollars a year were flowing through the securitization chain. Since anyone could get a mortgage, home purchases and housing prices skyrocketed. The result was the biggest financial bubble in history.
Real estate is real. They can see their asset. They can live in their asset. They can rent out their asset.
You had a huge boom in housing that made no sense at all. The financing appetites of the financial sector drove what everybody else did.
Last time we had a housing bubble was in the late 80s. In that case, the increase in home prices had been relatively minor. That housing bubble led to a relatively severe recession. From 1996 until 2006, real home prices effectively doubled.
At $500 a ticket, they've come to hear how to buy their very own piece of the American dream.
Goldman Sachs, Bear Stearns, Lehman Brothers, Merrill Lynch were all in on this. The subprime lending alone increased from $30 billion a year in funding to over $600 billion a year in 10 years. They knew what was happening.
Countrywide Financial, the largest subprime lender, issued $97 billion worth of loans. It made over $11 billion in profits as a result. On Wall Street, annual cash bonuses spiked. Traders and CEOs became enormously wealthy during the bubble. Lehman Brothers was a top underwriter of subprime lending, and their CEO, Richard Fuld, took home $485 million.
On Wall Street, this housing and credit bubble was leading to hundreds of billions of dollars of profits. By 2006, about 40% of all profits of S&P 500 firms was coming from financial institutions.
It wasn't real profits, it wasn't real income, it was just money that was being created by the system and booked as income 2-3 years down the road. There's a default, it's all wiped out. I think it was, in fact, in retrospect, a great big national, and not just national, global Ponzi scheme.
Through the Home Ownership and Equity Protection Act, the Federal Reserve Board had broad authority to regulate the mortgage industry. But Fed Chairman Alan Greenspan refused to use it.
Alan Greenspan said, no, that's regulation. Ideologically, I don't believe in it.
For 20 years, Robert Gnizda was the head of Greenlining, a powerful consumer advocacy group. He met with Greenspan on a regular basis.
We gave him an example of Countrywide and 150 different complex adjustable rate mortgages. He said, if you had a doctorate in math, you wouldn't be able to understand them enough to know which was good for you and which wasn't. So we thought he was going to take action. But as the conversation continued, it was clear he was stuck with his ideology. We met again with Greenspan in '05. Often we met with him twice a year, never less than once a year. And he wouldn't change his mind.
In this amazing world of instant global communications, the free and efficient movement of capital is helping to create the greatest prosperity in human history.
$146 people were cut from the enforcement division of the SEC. Is that what you also testified to?
Yes. Yeah, I think there has been a systematic gutting, or whatever you want to call it, of the agency and its capability through cutting back a staff.
The SEC Office of Risk Management was reduced to a staff, did you say, of one?
Yeah, when that gentleman would go home at night, he could turn the lights out.
During the bubble, the investment banks were borrowing heavily to buy more loans and create more CDOs. The ratio between borrowed money and the bank's own money was called leverage. The more the banks borrowed, the higher their leverage. In 2004, Henry Paulson, the CEO of Goldman Sachs, helped lobby the Securities and Exchange Commission to relax limits on leverage, allowing the banks to sharply increase their borrowing.
The SEC somehow decided to let investment banks gamble a lot more. That was nuts. I don't know why they did that, but they did that.
We've said these are the big guys, and clearly that's true. But that means if anything goes wrong, it's going to be an awfully big mess.
At these levels, you obviously are dealing with the most highly sophisticated financial institutions.
These are the firms that do most of the derivative activity in the United States. We talked to some of them as to what their comfort level was.
The firms actually thought that the number was appropriate.
The commissioners vote to adopt the rule amendments and new rules as recommended by the staff.
Yes.
Yes.
We do indeed. Unanimous, and we are adjourned.
The degree of leverage in the financial system became absolutely frightening. Investment banks leveraging up to the level of 33 to 1, which means that a tiny 3% decrease in the value of their asset base would leave them insolvent.
There was another ticking time bomb in the financial system. AIG, the world's largest insurance company, was selling huge quantities of derivatives called credit default swaps. For investors who owned CDOs, credit default swaps worked like an insurance policy. An investor who purchased a credit default swap paid AIG a quarterly premium. If the CDO went bad, AIG promised to pay the investor for their losses. But unlike regular insurance, speculators could also buy credit default swaps from AIG in order to bet against CDOs they didn't own.
In insurance, you can only insure something you own. Let's say you and I own property. I own a house. I can only insure that house once. The derivatives universe essentially enables anybody to actually insure that house. So you could insure that, somebody else could do that, so 50 people might insure my house. So what happens is, if my house burns down, now the number of losses in the system becomes proportionately larger.
Since credit default swaps were unregulated, AIG didn't have to put aside any money to cover potential losses. Instead, AIG paid its employees huge cash bonuses as soon as contracts were signed. But if the CDOs later went bad, AIG would be on the hook.
People are essentially being rewarded for taking massive risks in good times that generate short-term revenues and profits and therefore bonuses, but that's going to lead to the firm to be bankrupt over time. That's a totally distorted system of compensation.
AIG's financial products division in London issued $500 billion worth of credit default swaps during the bubble.